Welcome back, everyone. My name is Adam Rusmin.
Hello.
Victor.
Hi, everyone.
Thanks for joining us. And today we're going to talk about how you could invest at 55 nearing retirement. And the reason why we're doing this topic is because we have had some comments, questions coming in from people, real life people.
Yep.
Who have asked questions like, can you have a session to guide people who are in 55, plan to retire in 5 to 10 years' time, what type of portfolio they should have, how can they manage it? There was another comment, someone who's, 55, 60, have savings, but they haven't really invested up to this point. So they have limited knowledge in the market. What are the best strategies to manage the money? Some of them are like, I'm 55, my CPF money is free. I can start using it, but how should I manage the money? Because should I leave it in my CPF, or should I withdraw it and invest it somewhere else besides just bonds? What can you do? So we've actually had a lot of questions like that, and we just thought it was a great topic, especially if you are around that age range and you're going to retire soon and you don't really know what to do with your money, your CPF money. So that's the frame. Okay, so imagine someone like that. How should someone like that invest? They're 55, they could possibly work for 5 or 10 more years, have a bunch of savings, CPF money is now free, but they haven't really invested for in their life, in their career.
Yep.
Oh, yeah. I've not been that age 55 yet.
I know.
Okay. So it might be a little bit difficult for me to imagine the person in that situation, right? But fast forward, let's say if I look forward on my life 55 years down the road, when I'm 55, okay, I mean, I would have to look at a lot of scenarios, right? I think at that age, I think I might still have a house, right? I still have mortgage to pay, right? Because so it really depends on your scenario, right? Whether you have fully paid down your house or not, right? Again, why I say this because I think we don't want to give you the impression that this is a financial planning session for someone who is in the 55, right? But we just want to give some suggestion. Let's say if you're in the same situation, right? Because everyone's situation is different, right? Some people have kids, some don't have kids, right? By the time when I'm 55, my kids will be like in their 20s, right? And then I maybe have to think or plan for their education. Right, especially they're going for overseas for universities, right? Something like that. Yeah. Right. So there are a lot of situations, and some people might have elderly to take care. Because if I'm 55, then my parent will be 80s, right? So I think they might have some medical needs and all that. Okay, so these are some of the scenario that we cannot tell you what to do because we don't know where you are.
Yeah, we can't account for everything.
Yes.
Yep. So we just want to set the basic, I guess, criteria about what what it is. Around the age. How should you invest your money at that point?
Yeah, but let's say if I'm 55 today. When I reach that age and then I have never invested before, what would I do? Yeah. Okay. It's very difficult because I already know how to invest actually. Okay.
Why don't you imagine maybe your auntie or somebody? Yeah.
I think the most important thing is when you reach the age, right, and you never invest before, because the learning curve to investing is quite steep. If you don't have a lot of years to have gone through the cycles and up and downs, so that's quite emotionally taxing because you have to go through cycles, right? So if you've not been through the cycles, that means you are like a newborn baby going into the stock market. So that is actually very risky, right? So for a start, I think the first thing you need to think, right, is how can you preserve capital instead of making more money. That's the most important thing, because the moment you think of okay, I want to make higher returns, then you start to take bigger risks, right? And that is very risky when you are age 55, because the thing about investing, right, it requires time, right? If you have a long time, right, you can make mistake. But if you are age 55, you just started to do investing, right, the amount of mistake you can make is very minimum. So you have to take the safest route from here onwards. That's my take on it.
Yeah, I think that's a great point to make. I think we need to set that expectation. And then you invest according to that, rather than go, I think we can go into Bitcoin or shit like that. You can't do that. So what would you suggest someone like that do?
So I think the most important thing is, I think when you reach the age 55, assuming that you already covered your full retirement sum and you are ready for withdrawal, right? And you want to start to do investing. Okay, but before you even start to do investing, right, go and check. Let's say you got cash, right? Go and check what is the SSB rates, right? The SSB, the T-bills rates. These are the places good for you to put your money in, right? While you learn how to invest or going to the investing instruments.
Okay.
Okay, you cannot jump directly into individual stocks. You have to go into ETF first. Why I'm saying that is because at the end of the day, right, if you look at ETF, right, most index ETF, right, they tend to go up on the long term, except for the Japanese ETF, which was down many years, right? But most of them are up over a long trend, right? And index never die because they get replaced in the company, right?
Yeah.
So that is the most, I won't say risk-free, but it's a good way for you to learn while you build up knowledge in the market, because you won't die, right? The key about investing is you don't want to invest in one stock and the stock went bankrupt and you die.
You want to stay in the game.
Yeah, you want to stay in the game, right? It's
Yeah.
a marathon, right?
Yeah.
But it's just that you are very late at the marathon. People already run like maybe half marathon, already run 10 kilometers, you're still behind.
Don't
you're just
discourage
as the-
them. Come on, man.
Okay,
You
no,
can still complete the race.
Okay,
Come on.
but you still can complete the race, okay? But it's just that timing the market is very important
Yeah.
for you right now,
Yeah.
not time in the market.
Yeah.
Because you got, I would say, your period of time, I mean, we have to be honest here,
Yeah.
it's very short already.
Okay.
Right? So you have to time the market. So the best way to time the market is to really invest in like ETF, like your STI ETF, right? You won't want to invest in the US ETF, right? Because first you got currency risk, right? The dividends are minimum, right? And on top of that, there's also periods where the US ETF, right, is flat for almost like 20 years.
Yeah.
Right? You don't want to be in that situation.
Yeah, we do
Right.
point it out because a lot of people have, like the last 10, 15 years,
Yeah.
the US market has just gone on a crazy
Yeah.
bull. And you can, some people might expect this to carry on.
Yeah.
But that's not always the case. I think like there
Correct.
was a period, I think 2010 to 2020, the US market didn't do so well.
Correct.
So
So
and if that's near your retirement,
yes, correct.
that's not so good.
Yeah. So you don't want to be in this situation where you invest, then the next 20 years you're down.
Yeah.
And by the time you reach back your break-even point, you are 70 already or 75. Don't do that.
Yeah.
Okay. So the key is to really, I usually I don't like to tell people timing the market, but I think you have to do it, right?
Yeah.
You have to look at the, you only go into the index ETF, right? Let's say the STI ETF, right? Only when the market crash, right? So how do you know market crash, right? So especially for STI ETF, right? I went to track the 26 years record, right? Inclusive of dividend investment. STI is about 6.2%. It's literally higher than your, even if you just buy and hold, it's higher than your CPF
Okay.
SA.
Yeah.
Okay. But the thing about STI ETF, right, is it's very volatile. If you have bought most in the bottoms, I think you will do much better for the STI ETF. So I think it's good to wait for crisis for the STI. Right, where every time when it crash. So how do you know when is the crash, right? I think usually when people talk about bear markets, it's usually 20% drop, right, from the peak to the trough, right? So every time when 20% drop, you deploy some capital. It drops further, you just deploy. You don't deploy when the things is going up. You deploy when it's keep going down, because you know that the ETF will eventually recover. Okay, so that is the thing for your ETF part. Okay, but of course, before the ETF part, you need to go and look at your bonds and the what.
Okay.
But because you also need to wait for the ETF to drop. So your bonds have to put. So like in the case of now, I think the bond yield for SSB is
2.3.
2.3.
Yeah.
2.29.
Yeah.
Right. So as of now, we are looking at, and the T-bill is about 1.85. I think SSB is a very good instrument to put your
Okay.
money in, because you can take it out within a month.
Okay.
Yeah.
So you can actually react to the crash
Okay.
very fast.
All right. So I just want to summarize at this point. I mean, what you're saying is that if you've not really had a lot of investment experience,
Yes.
you shouldn't jump into the market.
Yep.
So before you jump in the market, put your money in very safe instruments like SSBs.
Yeah.
SSB.
Yeah. Keep your money locked up somewhere, earn some interest.
Yep.
In the meantime, start learning about investing.
Yep.
And you would recommend starting with ETFs rather than stock picking,
Yes, correct.
because an ETF is a more diversified instrument.
Yep.
It doesn't die like
Yep.
a single company could die, and you wait for the right time
Yep.
to get in. And in particular for this example, because we're covering, I guess, a more Singaporean focus kind of a scenario, the STI ETF is actually a really good one, because, like you said, there's less currency exposure. It's in
Yep.
SGD, strong currency, and good dividends. I think at this point, the STI is about 4% yield. And
Yep.
if you're near retirement, you want an instrument that gives you some amount of passive income, which
Correct.
the STI ETF gives you.
on top of that, there's
some capital
appreciation.
gains. Yeah. Whereas if you went to the US market, dividends are not so good. Currency exposure and stuff. I just want to correct something. I think just now I mentioned, I said 2010 to 2020, the US market didn't do so well. I mean, it's 2000 to 2010. Yeah, that was like a pretty flat market. And you don't want to invest in the market thinking it could go up all the like an escalator when it actually goes flat like that. Yeah.
I mean, the past few years is very good for the US market, but you cannot expect that for the next like 10 or 20. Nobody can predict, right?
Okay.
But you need to buffer for looking at the history and look at the Dow times and all this, right?
Okay.
Right. So once you get all this settled, then you start learning how to invest in individual stocks, dividend stocks.
Yeah.
Right. That's where you start to dabble a bit of money, and once you secure the main funds in all these first few instruments first. Right?
Yeah, of course the question you may ask is that, okay, how much should I start with ETF, right? The percentage of the portfolio. For someone who is new and if you've never invested in stock before, maybe you can start off with like 5 to 10% of your fund that is available for investing to get an idea how stock market works, right? Because volatility in the stock market is real, right? So sometimes it can crash like 20%. Sometimes like 0809, I think the whole US market crashed like 50%.
Yep.
Right. So what is risky for what is not risky for Victor may be risky for you.
Yep. Yeah. Correct.
Right.
Yep.
So Victor is comfortable with ETF, right? Well, some people are like, hey, this is so scary. I don't even want to touch it. Right. So that's why it's good to test it out, either 5%, 10%. Then you get an idea how the stock market will work for you. Of course, it goes up. Usually, you're like everyone is happy, right? It's a time when it comes down, when the market crash. That's a time where you see your real risk.
I think that's the thing about investing, that you can get all the knowledge, but how you react to volatility is very personal.
Yes, correct.
Yeah.
And if you've never invested before, this is your first time. Like, it's scary because this is your retirement money.
Yeah.
And you put some money in. Let's say, like you said, that's why you said put 5-10%.
Yeah.
And not so.
I think the money have to be slight sizable, because if it's too small, you don't feel anything.
But you don't want to, and you still want to be careful with how much you put in.
You want to put to the bare minimum that you know that if this thing drop 50%, you can feel something, right? Then you use that amount.
Okay.
Yeah. That's my take on it. Because you still have to learn how to feel the volatility.
Okay.
Right. But you know that the ETF will eventually recover.
Okay.
Right. So that is the most important thing, because if every time the thing drops and your heart rate keep going up, and you continue to drop and your heart rate continue to go up, right? And you go to the doctor and doctor say that your heart you really going to have a heart issue, then that is not for you.
Okay.
That is
you might not be able to enjoy your retirement.
That is not for you. The thing about investing is you have to be as stress free as possible. That's the most important thing. If that scenarios happen to you, right? Stay with your CPF, stay with your SSB, stay with your T bills.
Okay.
Right. Yeah.
So I think for someone who really very scared in investing in the market, the best way to deal with this situation is put it into something that is safe, and then on top of that, go and take the effort to learn how to invest, right? So if I'm 55, I will probably want to invest into income stock, high quality income stock. They will pay me consistent dividends, because that is the income that I'll be relying on, right? Once I retire or once my active income stop. Okay, so I will go and take the time to really learn how to pick the best quality dividend stock, because ETF may not be the best asset if you are looking for high yield type of return.
Okay.
Right. Of course, when I talk about high yield, I'm looking at just 4%, 5%, 6%. Sometimes even 7% you can find it in the distressed market like Hong Kong. You may find them. So, and once you build a knowledge around it and you have an idea how the stock market works and how it can serve you, that's where you can start to build a portfolio of high quality dividend stock that will pays you passive income over time. So you have that time 10 years to build, right? 55 to 65, right? So you take these 10 years to build that, shortlist those good quality income stock, and then you only invest in them when the time comes.
Okay.
You don't just buy because they are high yield and then you are attracted and you buy now. You have to look at the timing as well. Okay, especially for dividend stock. For growth company, of course, you can dollar cost average like US. Usually you still turn out quite well, but that's provided you have long term horizon, right? 10, 20, 30 years.
But I feel usually when you're 55, you are ready for retirement. You should start converting everything to your local currency and start getting dividends from there. That's my take on it.
So CPF Life is also one where I think once you reach the full retirement sum, right, you will get that monthly payout, right, once you reach the age of 65. Okay, so if you base on full retirement sum as of 2025, 213,000. I think that monthly payout is going to be, once you reach 65, it's going to be about 1,700 a month. Okay, but based on present value, 10 years later, right? Based on present value, that 1,007 might be actually worth 1,004 today. If you account based on 2% inflation, average inflation rate.
Yeah. But basically, you have very different instruments that you can mix and match to basically give you some kind of like foundation to protect yourself. So CPF is one, bonds, and then.
So I think in terms of the CPF also, I mean, if you hit full retirement sum, it's good for you.
Yeah.
Right? I think most people will hit at a point of time.
Okay.
Right. Most, but not all.
Yeah.
Okay. So the next thing is for those who have hit full retirement sum, only if you have excess cash and you want to top up to ERS, right? And you still have a lot of excess cash, then you don't have other instruments that you want to take risk, you can consider that. But if you are buffering for emergency or anything and you don't have a lot of excess cash, then do not go and top up all the way onto ERS because you cannot take back it. Because
we're stuck there forever.
Yeah, when there's emergency, you got no cash. So you have to really think very carefully, right? Whether do you need that sum of money or not. If you really need is emergency, you must think of all the scenarios that may happen, right? Then please do not.
That's true, because some people may want that liquidity for whatever reason instead of having locked up in ERS, and then you get a higher monthly payout, but it's stuck like that forever.
Okay. Yeah. But for me, I will never do ERS because I always have this crisis mentality where I don't know what will come, but I always want to have cash over there as a liquidity.
Okay.
Right.
Yeah. And then you're happy with FRS. That's good enough, and the payout.
So that is for me, but that may not be for you because if you already have everything covered, then you a lot of excess cash, I think you just go ahead.
Okay.
Yeah. Even for the bonds, I think you mentioned about it. I mean, it may be considered a lower risk instrument as compared to stock, but some bonds also come with high risk. If you don't know how to look at it, then you might be ended up buying into a junk bond. Right. So again, the idea on how do you go about understanding or studying, analyzing company, that is the basic, the fundamental, right? Then once you learn how to invest, you will learn how to study the company, financial, the business and all that, right? So that will gives you that certainty, the comfort to know what you're investing in, like whether it's a good bond. Okay, so that's why even bond, I don't recommend to someone who really like
like corporate bonds. But government
bonds generally are quite safe, right? So you're talking about 1 year T-bill, right? 6 month T-bill, 10 years T-bill. Those are very safe.
Yeah, I think corporate bonds are entire ball game altogether. It's almost the same as like learning how to invest in a stock, because you have to understand whether the company is like financially stable and all that stuff.
So I think Rusmin same one is 10 years SSB. Not T-bill.
Okay, so what are any key risks that people at that age should look out for? Like these are ways that we could invest and manage our money. What are the key risks?
Watch out for scam. It's very scary right now. The level of scam right now is like, wow.
Crazy.
It's crazy. I mean, these people are so smart at doing the scam, right? They should have used their brains and do the right thing. I think they can go very far.
Scams are really scary, because then imagine you've like maybe 500,000 saved up, and you're looking forward to your retirement. I don't know if 500,000 is enough, but they have some money. But then you're going to invest it, and then you put it in scam. It's gone. It's like it's essentially years of your life gone.
Correct.
It's heartbreaking.
Okay, I think the most of the time people get scammed is because first is greed. Second is fear, because the person who called them say that they are doing some illegal stuff. Okay, just remember that the government or any agency won't go and call you. Okay, anything, just hang up the phone, call the agency and check. Okay, but I can guarantee you they won't call you. Okay, and don't fall for any. That's why I say when you reach this age, right, don't fall for any greed. Don't go for like high returns, because if you want to go for high returns, people will intro you in all these high returns investment, and some of them may be scam. You don't know.
There's one more. Love scams.
Love scams.
Yeah. True.
It's very scary also.
Because sometimes you're lonely, and you could.
Correct.
I mean, men fall for that shit.
I think that time when we first started investing, like in the 2008, 2009 and 2010s, right? So there were a lot of scam. You have like Ponzi scams, right? So nowadays you don't really hear them that often, but if you ever, they may appear again. Right. If someone come to you and then they say, "Oh, there's no risk to invest in this. You get 2% a month return guarantee, no risk, zero risk," then those are scams.
Okay.
Right. Even though they don't look like scam, they're scam.
Okay.
I think the most
Speak by
important
experience.
thing is when things are too good to be true, it's never true.
Yeah.
Okay.
Right. So that is the most important tagline that you must always drill into your brain when you are age 55 or before you're age 55.
Would you say this is the biggest risk?
Yeah.
Yeah. I mean, for anyone, maybe not even
Yeah.
like for people near retirement. Anyone,
Yes, correct.
don't fall for
Yep.
scams like
Yeah.
that. Yeah.
Yeah. So I think the next risk is really, like I say, you don't go and invest in the US ETF because you are at the later part and they have years where they are down for like 10 or 18 years or so.
Yeah.
Yeah.
So please do not do that, right? Stay in your back in your home country. If you still really want exposure, just keep it very minimum money.
Basically take your time to deploy your
Yeah.
money. Don't once you get a CPF money, wow, you go
Rush.
much into
Yeah.
the stock
Yeah.
market because people say it's good.
Yeah,
Okay.
that's where I see a lot of people make mistake because they are so eager to deploy.
Yeah.
Be patient. At the end of the day, investing is sort of like wealth transfer. Right? If you are patient enough during the crisis, right, other people's wealth will transfer to you if they are not patient, right? So you really have to be. It's a patient game, I would say. It's just sitting out there and wait for the right opportunity. And when the right opportunity comes, you have to really go. Right? You cannot scared.
Yeah,
Right? You have
yeah.
to really go.
Yeah. Yeah.
Right.
So just to summarize, I think if you're 55, thereabouts, watching this, nearing retirement, if sum of CPF money, to summarize, what you would do with this sum of money is to put it in somewhere safe. So like Singapore savings bonds.
Yep.
In the meantime, you can earn some interest. And if you haven't invested for much during your career, it's time to start learning.
Yep.
Yeah.
And you can start with
The
investing in
ETF.
ETF
Yeah.
because it's a diversified basket of stocks.
Yeah.
It won't crash and
Correct.
burn. You know, if
Yeah.
you like stock picking, you pick the wrong
Yeah.
stock.
So your wealth is growing while you are learning
Yes.
instead of you waiting out there and it's just stagnant only.
All right. And for Singaporeans, we like the STI ETF because the currency is local,
Yeah.
tax free for dividends, and pays a dividend 4% at
Correct.
this point in time.
Yeah. And timing the STI ETF for you at this age is very important.
So you wait for the right.
wait for the
entry
right. Yeah.
for
Which
this.
I say, look at the peak to trough drop and
Okay.
look at the news. As long as there's a lot of bad news, just continue to invest. Yeah.
All right. And then if you decide to really get better at this, then you can start picking your own individual dividend stocks
Yeah.
or
Yep.
REITs that pay you a better yield than the STI,
Yep.
even though the STI has a very decent yield, which is a good thing. I think certain ETFs, they don't pay you a yield.
Yeah.
And for
Yep.
someone who's retiring, you want some form of passive income.
Yeah.
STI ETF checks all those boxes because there's the banks are in there,
Yep.
there's some REITs in there, the big
Yep.
REITs are in there as well.
We didn't say the REITs ETFs because they are quite interest rate sensitive also.
Okay.
Right. So in the event where the interest rates are very high, then the REITs will just go all the way down.
Yeah, I mean, you still
Right.
have to learn how to invest
Yeah.
in REITs. And
So that's why we say as
yeah.
a general index ETF. That's why we
Just
talk
the
about
STI.
STI, not
Yeah.
the REITs, right? Just
Yeah.
in case if you guys ask the REITs, why would never recommend the REITs?
Okay, so
yeah.
I think that's a pretty good summary of
Yep.
if you have limited investment knowledge, stick with the ETF first. And the home ETF for us would be the STI. Pays a decent yield. And then if you get better at this, you can start investing stock picking
individual stocks.
if
Yeah.
you want to do that.
Which you can
Get
get
much higher
better
returns.
return.
Yeah,
Yeah.
if you can do that. All right. And of course, don't fall for scams.
Scams. Yeah.
Okay, so for those who are watching this and asked the question, before in the past, we hope this really helped you out because it's a real thing that some people out there are facing. Yeah, they
Yep.
don't know what to do with this cash nearing retirement. What should I do? And I think you should just take it slow and steady. Don't
Yep.
rush.
Yeah.
There's no need to make your pot of gold in that way.
Yeah.
Yeah.
Correct.
Like you said at the very start of this whole roundtable, it's about capital preservation,
Yeah.
making sure you stay in the game,
Yeah.
and you don't want to bust out.
Yeah. Correct.
All right. So I think that's what we want to share. All right. Anything else, guys?
That's all.
Yeah.
Okay. So my name is Adam Rusmi. And
Thank
Victor.
you.
Thank you.
Thanks for joining us. I hope this is really, really helpful for those who are in this exact situation. If you have any more questions about that, we're happy to answer them. If we can help you out, we'll tell you what we think. We can't give any recommendations of what you should do because this is not financial advice.
Yep.
Yeah, we just want to give you some ideas you can explore, like general best practices. But please ask your questions if you have any. Please like this roundtable if you like it. And of course, subscribe to our channel. Many more roundtables coming. We'll see you again.